Welcome back, members. Now we have session audit reports, audit report formats by CA Heena Kauser AP. Can I request CA CP Jain, our Bangalore branch MC member, to escort the CA Heena Kauser madam to dais and then welcome the floor. Thank you. I have privilege in introducing today's speaker, CA Heena Kauser AP. She is a chartered accountant. She is also a Bachelor of Commerce. She is partner at Guru & Jana. She specializes in statutory audit and IFC design and implementation and special assignments. She is part of assurance team and handling statutory audit and specializes in IFC implementation. Administers the CSR activity of the firm through Mahathir Guru & Jana Foundation. With this brief introduction, I present before you CA Heena Kauser AP. Over to you.
Happy evening to all.
Good evening.
Before starting this session, I have few disclaimers to make. One, I can never be as humorous as Raja because Surya ninge tarsh torsakagalla. We will use that mic for this mic only. As we start the session, I have one small story to share. I'll start with that. Once in a road, there was a shepherd who was grazing the sheep, and he was walking along. Along with him, he had a herd of sheep going. So suddenly, zoom, a Mercedes-Benz passes, and very nice guy. Then Mercedes-Benz passes, and then it stops after some time. Then from the car, there's a very nice guy, very well dressed, very nice. He comes, gets down of the car, and comes towards the shepherd. This guy is astonished. Why is this guy coming, and what is he asking? Then he said, "Hey, I can tell you how many ships you have." But this guy is very shocked. Why is this guy asking? You give me a chance and do it. Then he says, "Okay, I'll give you the chance." And he says, "Okay." Then this guy goes to near the car, opens his car. There's a small mini office. Takes his laptop, then sits with all the printer and other things. Then does some calculations, statistical analysis, everything, and comes up with a report and comes to the shepherd. "Hey, see, I did everything. I did an analysis of all your ships, everything, and then I could understand that you have some 1,500 and odd ships which are there, 1,586 ships which you have." This guy shepherd looks at him with very shock, and also at the beginning of the thing he says that if I tell correctly, what will I get? Then he said, if I tell correctly, you have to give me one nice ship which you have. So this guy comes and tells that you have so many ships. Now, as per this thing, shepherd had to give one ship to this guy. So he gives the ship. Then he takes to the car and then keeps. Then shepherd comes running. Sir, can I tell your profession? If I tell your profession, will you give this ship back to me? Then he says, yeah, you can do all that. Then shepherd says, "Sir, you're auditor." Then this guy says, "Hey, how can you tell my profession so accurately?" Then this shepherd then says, "I did not tell you to come, you only came. Then I did not tell you to count, you only counted. Then because you counted, you took my ship. So that's how I could guess your profession." So this humorous, this thing, the one thing which I liked in the entire thing is, this guy has a mini office and he comes up and then calculates and comes with a report. And that is the work of an auditor, which is there to give a report. And that is the topic which we are going to talk about also, audit report. And audit report has to be either in a specific format, and this seminar specifically we are limiting only to the format and relating to the Companies Act. So what is this seminar going to cover? One, what is the objective of the audit report, and how the auditor forms an opinion. We're not going to touch upon the types of opinion because it will go into a different tangent. Then during the course of the audit, we will be issuing multiple reports. One, as an auditor, I think most of us sitting here will be doing small and medium company audits. And hence this seminar basically designed for the small and medium companies. And hence we have the entity reports which we are going to issue under the Companies Act. Plus what happens is, now there are many companies for which Ind AS is applicable. Normally, all of us are used to giving the IGAP report, but now, yes, we have to give the report where Ind AS is applicable. So there are specific tweakings that needs to be done in the report. We will be touching upon that. Then when you do a company, if it is a single one company, okay. But if it is a group, then there is a parent and a subsidiary which is there. Then it happens that we have to do the consolidated financial statement. Then the report is different. Again, the audit report remains the same, format remains the same, but there are a lot of tweakings which needs to be done in the consolidated audit report that we would be touching upon. Plus and during the course of the audit, when we are doing a listed entity or an unlisted entity, many times management comes with a peculiar requirement. So we have to give it to the investor, quarterly statement. Then we have to, if it is a listed entity, SEBI requirement is there that we need to do the limited review, quarterly reports needs to be issued. So we are covering the formats of the limited reviews in this. And last but not the least, which is there are many special purpose reports which are issued during the course of the audit. And hence this is very, very important to know what is the purpose format at which we will be issuing the special purpose report. One thing is, like at the end of the session, Raja spoke on the fund utilization certificate. And this fund utilization certificate, what he displayed was from the company giving assurance that the fund is spent. But usually as an auditor, we don't take what the company has given. We would require the auditor, any independent or a practitioner to certify saying that the fund has been utilized. At that time, that format will not work. We have to refer to the special purpose certificates and the reports. Those are the things. Plus, there are few things in the audit report which are not of routine nature. There are EOMs which will be issued. There will be CAM which will be issued. There are other matter paragraphs which are there. And if you see the audit report, there are some paragraphs wherein we have to certify the going concern of the company. If the going concern is affected, there are things like material uncertainty of the going concern that needs to come as a separate paragraph, which we will be dealing. And one more very important thing is, when we are reviewing the audit report, 100% every time you tell, the same mistakes get repeated. And these are some of the mistakes which are very common, which we were going to talk about. And as is, I'm relying on Raja as a fallback option for any of the questions and answers as such. So going ahead on the report, which is there, as I said, that auditors work as after the audit is to give a report. So how report is on what? Report is on the financial statements. How is the report given? Report is given based on the evaluations of the audit evidences that are obtained during the course of the audit. And hence, the report should clearly express the opinion, which I have opinion in a written format. This is what is the work of an auditor and objective of an audit report, which is there. And also, while forming the opinion, the auditor concludes that the financial statements which are there are free from material misstatements. If he feels that it is not free and there are some things which needs to be qualified, then this opinion needs to be modified, and then comes a modified opinion that needs to be issued. So while forming the opinion of the audit report, one, if it is an unmodified opinion, he will be giving where there are financial statements are free from misstatements or there are no concerns, then comes an unmodified opinion. If there are any of the concerns, it becomes a modified opinion. And also, the auditor also says, while forming the opinion, that the financial statements are prepared with the applicable accounting framework. These two things are certified in the audit report and are very critical while forming the opinion. As I said earlier, these are the 5 reports which we will be taking it further. And what I am going to do is, each of the report, we are going to see what are the format which is there. All of us know that the audit report format is specified in SA 700, and hence this many things will be covered through the SA 700. So when I say an audit report, I will be toggling the screens between the report and the title here. The first thing which comes in the audit report is independent auditor certificate. This can be given only by the statutory auditor, and he will be termed as an external auditor, and hence independent audit report will be given. The next comes the address to whom this report is addressed to. So here it will be addressed to the members of the company as an auditor. Then the third comes is on the opinion. Earlier we were not giving opinion earlier. Now the reports which says that opinion. Here, if it is a modified opinion, we have to specify very clearly it's a qualified opinion. And in this case, because it is an unmodified opinion, opinion paragraph comes. What comes in opinion paragraph as such? Opinion paragraph comes the company for which you are auditing. Then it comes the financial period for which we are auditing. Then comes the statement of financial statements, the financial statements. What all it compromises of? It compromises of balance sheet, statement of P&L account, cash flow, and accompanying profit and loss account. Okay, so this comes in the case we are following IGAP. In case of Ind AS compliant companies, we also have to add SOCI, that is the statement of changes in equity, which is there. So these four forms. Here, actually, I would like to bring one small this thing. This was last year during the audit. Audit? The small company definition got changed suddenly. Okay, and then because of the small company definition getting changed, and for small companies, cash flow is not applicable. And this amendment came in the mid of the year, and suddenly all of us thought, okay, cash flow madade beda. And many of the financials actually, they told balance sheet, statement of P&L, and then the accompanying notes which are there. So cash flow was removed from the audit report. Okay, but then we had Raja to fall back. So we had asked him what is this thing. Then he said that the definition of financial statements includes cash flow. So whether it is small company or a big company or any company for that matter, cash flow becomes mandatory. So there is no exemption for cash flow as such. So cash flow has to be included in the opinion paragraph that we have verified the cash flow statement. Then in the opinion paragraph only, in the opinion paragraph only, the auditor explains his opinion, where he says that based on the explanations and information which is provided to him, the standalone financial statement as required are in conformity with the accounting principles, and that it is true and fair. So this opinion has to be there. In case it is a qualified opinion, we say that subject to the qualifications below, this is the opinion which is there. So this paragraph becomes very, very critical. Now the auditor has stated, okay, this is my opinion on the financial statement. But how did he base that opinion? What are the things that needs to be taken care while giving this opinion? So when the auditor gives the opinion paragraph here, so he says that the audit was conducted in accordance with all the standards of the auditing which are there. Then he says, also states that there is an audit responsibility paragraph which comes in. So he has taken care all the assertions and the diligences which are told in the audit responsibility paragraph, plus has complied with the ethical requirements. So if you see here, each of the point is critical because each of which is supported by few of the things. When it is told ethical, you are going to the code of ethics, you are commenting on the independence, that the audit has been done independently. So each of it has been spoken in the basis of opinion. With basis all of this, this is the basis which it is said. This is what is said in the basis of opinion. The third thing which the auditor has to say here, one second, I'll go to the PPT. The third thing which here, as he move forward, is on the going concern. Going concern assumption actually was not there earlier. It has come recently. Earlier, we were giving it in the EOM, but now there's a separate paragraph called material uncertainty of going concerns, and hence there has to be given. What does that mean? Many times I'll tell saying that during the audit, we see that the profit, it's become negative or the company's net worth is fully eroded. At that point of a time, as an auditor, the first thing we need to see is whether the going concern is got affected. Many times it is so that it's a group company and it is one of the subsidiary. The parent entity is very cash rich, but one of the subsidiary has gone negative. So that time, even if you want to give the going concern note for that entity, the management will say that it is not going, it's not affected. Why? Because the parent company will support. At that point of a time, will you just listen to the company and then go ahead and remove the qualification? Should we do that? Auditor, we can tell, sir, but the company will tell, I have the cash rich money, the parent company has lot of money. Should we give a qualification for that? No, we cannot give a qualification. Why? Because in the audit report, qualification is somewhere where you are telling that it has got affected. Now here what it happens is the parent company says that I'll support fully. But in case of management representation, how are you telling the stakeholders of that particular company, saying that its net worth is eroded, the reserves have gone, but still the company is going concern? Sir, I can't hear you at the back. Maybe some mic. Dear at the end.
Hello. If the management, hello.
Yeah.
If the management is giving an assurance that they're going to fund the company, and it's not going to be affected by the net worth, then we can rely on the management recommendation and avoid a going concern qualification.
But then what will you put in the audit report? Management has told you in a closed room.
Yeah. Maybe we can, instead of qualifying, we can give a, in other matters, we can express that point which expressed by management instead of qualifying.
Yeah, there are two things which we can do. Whenever there's a going concern which is got affected, as is many times what happens is few of the subsidiaries, the network gets eroded, and that is why the going concern is affected. The parent entity always supports the subsidiaries, and hence it is very, very important to get a comfort letter. And many times this comfort letter is very generic, which says that XYZ company will support in the existence of this company. As an auditor, whether it is sufficient? No, it's not sufficient, because as a management, they have to tell what are the future prospects of that company and how are they going to see that the company is there in existence and it is not going for closure. And this is one of the critical thing also. Why? Because any of the reviews which comes in either from the institute or from any other thing, they will definitely ask how the going concern comfort is taken. And if you do not show that comfort letter or tell we have taken a representation letter, it won't suffice. Second thing, what we need to do is whenever such kind of a scenario arises, in the EOM paragraph, please give an emphasis, not in other matters, please give an emphasis in the EOM paragraph that the net worth of the company has got eroded. The company has been in a loss, and there is, even though these two are eroded, the management has extended the support to the entity, and hence going concern is not affected. Also, the auditor is required to see what is the future projects for this company. Yeah. Yes, that is required to be specified by the management in the financial statements. Then only the auditor has to report it in the audit report.
The auditor cannot give an emphasis of opinion if it is
Yes,
not mentioned in
yes.
the financial statement.
Yes, first the management has to agree that there is an going concern effect, and then they have to give a note in the financial statement, and then EOM needs to be given. Sir, I will be very happy to give a qualified opinion when the management is giving a comfort letter, but will the company agree? What happens in a group companies is this will get consolidated. This company's balance, whatever the financials audit report is there, it gets consolidated into the main entity audit report. The main entity will show this qualification on the face of this. Because you've been giving the Reliance example, I'll tell you. Reliance has one small company which has got a going concern impact. The auditor is hard bent and gives the qualification. This qualification will come in the main listed entity. Will the company agree? That is why in the audit report, in the auditor's responsibility, they have added one paragraph, sir, which says that whatever audit report you are displaying or whatever you are disclosing, you have to discuss with the stakeholder, get their concurrence. Earlier, it used to so happen that auditor is an independent entity, they used to give whatever it is there in the report. But now they have added a paragraph in the audit report which says that this needs to be discussed with the stakeholders. Yeah, means the board of those charged with the governance of the company. And qualification where you are getting a comfort that the going concern is there. I don't think it is required. If the company is agreeing, definitely you can give. But then you have to, in case you are giving the going concern qualification, you have to give one more thing, saying that when there is a going concern, the balance sheet needs to be prepared on a liquidation basis. That is as is basis. That means to say that all the assets have to be shown in a realizable value. If and the liabilities need to be shown in the whatever is the receipt for those. And only then you can tell that the going concern is affected and then the balance sheet has been complied with the going concern assumption. So if you're telling going concern as a qualification and not complying with the balance sheet requirement, still it will be an issue. If you're qualifying, you have to qualify both the things. Raja can add on.
Check. Yeah, actually what happens is, as an auditor, giving a qualification is not as a matter of right. It's not that just because I'm an independent person, I give qualification for everything. Correct. So therefore, what happens is, to give a qualification, I should have enough of undisputed points to say that it should be qualified. So here in what Heena was explaining to us, we didn't have any undisputed points to show that there is a qualification to be created. So this is like, for safer side, this will not be a right way to do it. Like if I go to a doctor and I tell him that there's a chest pain, he cannot say on safer side, I'll call it as heart attack. That's not the gas problem, right? So therefore, on the safer side, I'll do an angiogram. So what happens is, I think what Heena was trying to explain also is, if you see today's amendment in the audit responsibility also says, you can't simply, just because you are an auditor, you can't start giving qualifications unless you've also discussed with them and got it into their conference also that what I'm telling is right. Then when there is a dispute between both of us in the agreement, now when she has added that extra caveat, telling that the holding company is willing to support, I think that's enough of a caveat for us to say that the holding company is supporting the subsidiary entity. No, that's a different story, but I'm telling as a very true. So therefore, every gas problem cannot become heart attack, no? So
yeah, that's why we can highlight saying that in the EOM, as sir was suggesting, give a note in the financials saying that though the net worth is eroded, there's a support from the company. Basis that letter, we are confirming it.
like what you said, sir, you're still giving it in the EOM. It's not that you're avoiding it. You're still putting it in the EOM, telling that this is one of the points to be there. But it will not qualify the report. You can clarify that. All EOMs doesn't mean it's a qualified report.
The next point
Yeah.
is that only. So when there is a going concern, I think going concern, we are clear. If the going. Yeah.
And how do we justify that?
So it happens that it is very rare scenario where the holding company is having negative net worth and it's having even the losses, but the subsidiary is having the profit. What happens is standalone holding company may show loss, but when you do the consolidated, because subsidiary is having profit, it may be profitable.
What he means is most of entities might be only cost plus entities or something in respective areas. So cost plus, it will always be in profits, whereas ultimate holding company might be in losses.
Both are in India.
No, that would be an MNC,
MNC.
headquartered outside.
See, in that case, what happens was, one, you will have to, in that case, maybe the subsidiary is still showing profitable. There are one more assumption on the going concern. We are looking at a profit next 12 months whether the company can be a going concern, and also the transfer, whether you have the enough of cash receipts from the parent entity. If the parent entity is becoming negative, obviously there'll be no cash flow to the India entity if it is a cost plus entity, ideally. So then the receivables will become huge. Maybe that is also one of the criteria which you can look up. If the receivables are more than 1 year or 2 years, then obviously the parent entity has no cash to give funded to the subsidiary entity. Then it is an alarm that going concern is affected. Otherwise, usually when we do cost plus entity, holding entity, we are nowhere saying, because we are independently reporting the subsidiary entity. But wherever there are key indicators are not only profit or the reserves, but also the receivables which is there from the parent entity. So based on that key indicators, we can judge whether there is a material uncertainty as such.
Reasonable certainty or virtual certainty and the ordinary course of business being carried on and the future customer orders. Say, for example, in AS 22, that is how we ascertain deferred tax asset or so. So in the same analogy should only be the figures, because say some companies intentionally they go on cash burning model, even though startup companies. But whereas if you see, they would have they are slowly capturing the market space. So in that case, should we yardstick different things also? Just wanted to understand, should it be seen?
Basically, key indicators are profit and negative net worth. See, even if there is no profit in the company, as long as there are reserves in the company, we feel it is a going concern. Now, net worth also negative.
Yeah.
But I'll tell you, this same scenario has happened recently. We were in a management discussion. In fact, we were discussing with the director. The director does not want to give the comfort letter. Okay, he's telling, see, why are you seeing profit now? Next 4 years, I'm making huge profit. You see that, why should I give you a comfort letter? It was a point of discussion because we also have to safeguard ourselves. The management, if you see startups, the multiples what they give on the revenue, in next few years, every startup tells that in next 4 years, I'm unicorn. Will you go by that? Or will you go by an actual scenario, what is there? Is a judgmental call which the auditor needs to take. Suppose I'm seeing the balance sheet today, the net worth is negative, it is a loss, and there are no projects in hand. Okay, then it is a clear indicator that in next few years, either the company will be a shell company or it will be under the liquidation. Or either and second scenario can be the company's prospect is very good. They may have huge projects in hand. They will tell that, the multiples are good. We will be making this thing. But whether are those reliable? Both the things are very judgmental and company specific. It's not only the profit or the net worth. There are many other things which needs to see whether the going concern is affected. That is why the standard is very clear. We don't have to see it next 5 years, 10 years. If we are able to judge for next 12 months, then if the going concern is not affected, that is sufficient. And also as an auditor, whenever we are giving the going concern note or we are telling that, we are satisfied with the management, please take along with the comfort letter, take the management plan. How are they going to revive the company, or what are the future action plans which the company is having? In this case, which I was telling, which we were discussing with the management, the board is not ready to give the comfort letter, which itself raises a suspicion. Why is he not giving? We are telling you put all your projects, whatever is there in the future, give us a letter based on that. He is not agreeing. That itself leads to suspicion. Why is he telling this?
This audit report is part of standards of auditing, right? And which has to compare with audited and ensure that no himself knows the disciplinary committee in the other day.
Yes, yes, sir.
No one has said this standard audit.
Yes, yes, sir.
So better to leave the.
So disciplinary committee has a checklist for the, if you see the QRB, there's a checklist in the SQC also, where as a going concern, what is that an auditor needs to follow? Okay, it very clearly says that as an auditor, you have to assess whether the company's future has the sustainability, and that sustainability check has to be there for 12 months. There has to be a letter given to the management based on the assessment which you have done that there is a going concern impact. The company has to give you the future projects which it is having, specifying that the going concern is not affected. And you keep all those documentation and tell, this is the documentation which I have. Based on that, I have certified. Then you were clear with the disciplinary committee, QRB, or any other review which is there. They ask only for documentation. If you have a closed room discussion and then just keep quiet, then you are not able to say, we are not able to save ourselves. You should have documentation that we have done all the ticks. Then only we are telling yes. Moving on to the emphasis of matter which is there. So this is the basically going concern came in because lot of places there was an ambiguity, and then many places people were not giving it very clearly. Then when the other thing is on the EOM. EOM is where matters which needs to be emphasized in the audit report, where we can tell saying that, the company's going concern is got affected. But however, basis the reports, whatever we have received from the management and the plans which the company is having, we are satisfied that the going concern is not affected, and hence we are giving an emphasis in the financial statements. These are the things which will come in during the audit. There are many things which we feel that this needs to be emphasized. It is not a qualification, but this need to be emphasized and to be told to the reader of the financial statement. That is when EOM comes in. Then coming on to the key audit matters which are there. Key audit matters are applicable only to the listed entities. However, unlisted companies can voluntarily give the key audit matter. What is the difference between EOM and key audit matter is? Key audit matter is more actually relevant from the auditor's perspective than from the readers of the financial statements. As an auditor, we take many assumptions and we take lot of explanations from the company, and based is that we base the opinion. And many times we feel that we have taken some stand which the reader has to know, and how we have satisfied ourselves that the risks have been mitigated has to be made available to the reader of the financial statement. To tell one classic example, what will come in EOM, we are doing recently an audit of NBFC, and the NBFC has lent lot of loans. And there is an expected credit loss which has been provided. This expected credit loss which has been provided on the loans is been done based on lot of research which the company has done. It has gone and seen what are the past trends. It has seen the time value of money. Then it has seen what are how much ECL, what the industry average which is giving for a similar company. All of that has been scientifically driven, and based on that some percentage has derived. And this during the audit we have discussed at an elaborate length. Now, being a very, very critical element in an NBFC, what is the ECL that we are going to provide? We would also want the reader of the financial statement to say that there is an ECL in the company, that is the expected credit loss, and the company has done so much analysis. And based on that analysis, we have also reviewed the assumptions, and based on the assumptions, this is our observations, and we feel that we need to give a key audit matter. That is when a key audit matter comes in, and not in qualification or any other things, where we are satisfied, but we want the reader to know this is what it is. Moving further on to the audit report. Then comes the management responsibility on the financial statement. So we've been talking many things on the auditor's responsibility. In the audit report, the auditor also states the management responsibility, wherein he states that the financial statements are the responsibility of management, and they are required to prepare it. And in preparing that, whatever the controls are required, those have been exercised judiciously. And this has been prepared with the accounting frameworks which are applicable. Also here again, we are emphasizing that going concern testing has been done by the management, and they have felt and they have exercised due care, and based on that, going concern is not affected. So because there is an additional paragraph on material uncertainty on going concern, even the management also confirms the same. If there is some ambiguity between the auditor and here, it will also get affected. Moving on, this is very, very critical here. Earlier, we used to give auditor responsibility only a small paragraph, which is there. Now, the auditor responsibility has become almost like a big 2-3 pager responsibility. That is why maybe the standard has said that instead of diluting the attention of the reader of the audit report, you can give this audit responsibility as an annexure also. And they've given an option. Either you can show it in the face of the audit report in the main report, or it can be as in part of annexure. And you can tell that the audit responsibility has been stated in the annexure, which is annexed along with the audit report. So in the audit responsibility, what are that we are going to tell? One, we are going to tell that we are telling that we are giving a reasonable assurance to the on the financial statements of the company. Saying and also that what is that we are giving a reasonable assurance? We are saying that we are providing a reasonable assurance that the financial statements are free from any material misstatement, whether by fraud or an error. Okay. And also, and here again, we are going to tell what does reasonable assurance mean. Reasonable assurance here again, we are saying that it's only reasonable. We cannot be 100% accurate. We cannot see every fraud in the company. And hence that is why we are only giving a reasonable assurance. And then again, because the first line of the this responsibility states that reasonable assurance whether the financial statements are free from material misstatement. So the two words which are very critical is reasonable assurance, and then what is material misstatement. So when we say what is material misstatement, the misstatement should be together if it influences the decision making of the management. That is a misstatement which we are going to refer. It cannot be a small audit entries which comes in, or any other thing which comes in. Based on that, we tell saying that, you know, there are 10 audit entries I passed, the financials are materially misstated. No, we have to see that those misstatements lead to the decision making or will change the decisions of the management. Only then it is a material misstatement. And also from the standards of auditing which is there are a couple of things which needs to be explained here in the audit report, which says that the financials, the auditor has during the course of the entire audit has the professional skepticism which has been followed. So what is professional skepticism which is there here? So when I say professional skepticism, there has to be a thing where we can question. Many a times it so happens that we leave the audit initially to the article assistants or anybody and take a view from them saying that what have they done. Initially they may be thinking this is correct, but it may be wrong. That is where the role of the senior comes in, where everything has to be seen with a professional judgment and a skepticism, whether this will lead to any fraud or error. So that is one thing which we are going to specify in the audited report. And then there are a couple of 7 items which the standard requires us to tell, saying that we have done and taken care of this and are duly diligent. First point is that to identify the risk of any material misstatement in the financial statement, whether due to fraud or error, which is there. And also state that we have obtained enough of evidences during the course of the audit, basis which we are actually opining on the financial statement. And the second paragraph here states that if you see the screen, it says that obtain the understanding of the internal finance controls of the company. Here there are 2 scenarios. Many places what happens is during the audit, IFC is not applicable. IFC is not applicable, and hence we will be telling that IFC is not applicable. Wherever IFC is applicable, there is a separate report which comes in. So we have to ensure that when we are actually giving this paragraph, in case IFC is applicable, we remove the line which says here under section 143(3)(1) of the Companies Act, we are responsible for expressing an opinion on whether the company has adequate financial control system in place and operating effectively under such controls. This needs to be eliminated, and we have to give the first paragraph which is there here. Apart from that, in the auditor's responsibility, we also have to state that there are appropriate accounting policies which have been followed, and these are reasonable to the company. See, when we say accounting policies, we are required to evaluate the accounting policy. Many times we will go by the company saying that, okay, depreciation, they are following whatever rates it is. and hence we go by that. That is why wherever the depreciation rates are different from the company act, there has to be a technical evaluation done. So many times we do not take such kind of a note along with the financials. And also on the going concern, again we are emphasizing here. So going concern is so important that we have to give a separate material uncertainty paragraph. Then again here also it says that the appropriateness of management use of going concern has to be evaluated. In case the going concern is affected, this paragraph needs to be modified. So I'll just show the report also in case of a material wherever there are going concern impact, the audit report needs to be changed in multiple places. I will display the report also where all the changes have to happen where going concern is got affected. No, not applicable. Yes, it only says on the companies and LLPs are not covered. And also evaluate on the presentation structure of the financials, including the disclosures. So here, if at all we say we have covered everything, we are telling that we have evaluated the structure, presentation of the financial statement. We have gone through the accounting policies and other things. We are telling on the going concern. We are telling on the financial statement presentation. So we have covered most of the aspect. And the other 3 paragraphs are something which are very this thing. Earlier, the audit report was the auditor's responsibility, and auditor can go ahead and issue the report without even discussing with the management. Now with this paragraph here, we are telling that we have communicated with those charged with the governance, among other matters, the planned scope, timing of the audit and significant audit findings, including any significant deficiencies in the audit control, in the internal control that we identified during the audit. With this, we are telling that we have discussed the entire audit findings and the audit report with the management of the company, and basis which we are be giving the report. Also going here, we are also stating that we have complied with the independence requirement of the audit. This is very, very crucial. This is one of the requirement of the SQC also, saying that when you are doing the audit, we have to ensure that the people who engagement team who is doing the audit also are independent. And it requires us to take a declaration saying that the people who are doing the audit are independent and are having no relationship with any of the people in the company, or do not hold any shares or anything of the company. This is very, very critical, and which we miss out taking everything. So in office, what we do is every year or every audit, we do the independence declaration, where every person is required to state the relation in case they have with any of the clients. Also, many times we circulate the client list and tell whether any of you are related to the clients, because we will not know in a big organization or anybody like who is related to whom. It is better to take an independent declaration. And this is also whenever the reviews come in, this will help safeguarding ourselves that we have taken the independence declaration as such. And other than that, there is this other matter paragraph which comes in. See, we have an EOM, we have qualification, we have key audit matter. Again, there's something called other matter. What is other matter again? So other matters are matters which are generic in nature, but we want to tell the reader in the financial statement, yes, please take note of it. It may be saying that, you know, the previous year some other auditor was there, and current year we are the auditors. And hence we will tell saying that the previous year numbers have been audited by the erstwhile auditors, and we are only opining our view on the current year financials. Or telling that the branches which are there are audited by somebody else, we have taken cognizance and noted that, and then we have been doing the audit. So anything of those things will come in the other matter paragraphs. Many times we'll skip the small minute things, but it is very, very critical to see whether we are putting this. And another thing is this audit report becomes very, very critical, the format of the audit report, content, and where we present all these things. Why? Because now the vigilance has become very, very much than earlier. Earlier, we used to feel NAFRA was the only one, and we are not doing listed entities. So we are outside the ambit of any of the reviews. But now QRB has been very, very active. They've been taking up files which are very smaller, and the private companies also. So whenever QRB comes, they will ask all these things, whether have you done. So it is better whenever we tell, we need to demonstrate that also. Many times in IFC, whenever we do the IFC, we tell the company, demonstrate your control. Okay. So the same way, whenever the QRB people come, they also ask the same thing, demonstrate each of the audit procedures, what you have done. Instead of telling like this, or to have an oral conversation, better to have everything in writing. Yes, sir. Yes. So referral client, yes, but you will be doing the audit independently.
Suppose you come without money,
Hmm.
here I am being treated to for a year. But if I am moving, then chances are less.
That is why the independence comes in. Maybe I'm not getting, like, suppose if many a time we'll know the client. Once we go in, we know the client. And that's how the auditor work is there, that we are independent.
There will be some gray area. But if I know you first time, the last one, only again your audit work.
That time client may take little liberal stand, saying that, you know, ये कर दो, इतना ही है, इसको pass कर दो, आप क्यों डाल रहे हो? ये सब बात है. But what I feel is, as an auditor, wherever you have to put your foot down, we have to put the foot down. At least at a firm level of ours, wherever such kind of things come in, we have a committee which will take care wherever such kind of issues are there. But where you are telling that the client pushes you beyond, इतना ही है, इसको मैनेज कर दो, बैंक में लोन नहीं आता है, इसको पास कर दो. No, those things are there. We have to tell, either we have to take care of him or we have to save our membership. So it's a choice which each one has to do, whether we are going to listen to the client or we are losing the membership. And it is not now, it is earlier maybe Nafra only, now QRB to picks everything. You want to add something, Raj, on that?
See, the best thing to do is, if you see, even for the QRB requirements also, the major focus is on SA. So if you're talking about independence, just ensure that you're following SA 200. If you're talking about either KM, then you ensure you're following SA 701. So as long as you're within the ambit of SA 701 for KMs, or in the ambit of SA 200 for independence, so most of your questions gets answered thanks to the essays today, your standards on auditing, that will give you a lot of your answers. So where you have to protect yourself is through, like what Heena was already explaining, what are those documentations you require is all given to us on a platter. So for independence, you got 200. For KMs, you got 701. For going concern, you also have the help of IBC, which has defined what is going concern, because all the IBC also today defines what is going concern and what should be liquidated and what should not be liquidated. So we've got enough of references today, and taking the help of all that, only your documentation should be done. So when it comes to, even if you see SA 200 for that matter in your independence case, somebody referring is not a matter of independence being hampered. Whether there is an interest in the management of that entity, which can be through acquaintance, what you have, can be a matter of SA 200. But so therefore, this point of reference will not be part of SA 200. I think I'm clear on this.
Going further on to the audit report, after the other matter paragraph, it comes on report on other legal and regulatory requirement. When we say other legal and regulatory requirement, there are two regulations which we need to certify. Tell here, one on the CARO, whether CARO is applicable or not. If it is applicable, there is a separate annexure which comes in, and tomorrow there's a separate session on the CARO reporting. So we're not going to touch upon anything here on that. Then apart from that, under 143.3, we are required to specify 8.7 points here, which are all, which we have been doing day in and day out. One, to the best of the knowledge what we have sought all the information which is required for the audit, and the books of accounts are in compliance with the financial statements which is there. Here actually we have to take a note of one thing. The second one is the balance sheet P&L are in agreement of books of account. Many a times during the audit, what we feel is there are a lot of audit entries because the company follows SAP or Oracle, which is linked to the global accounting package. They are not able to pass the audit entries. To that extent, if you see the books of account, it will not match to the audited statements. Should we qualify here or give a note here? Yeah. Note has to be given. Any other views here? Is it okay to have the out of book entries? Here, when if you read this paragraph, it says that the balance sheet, statement of profit and loss account, and the cash flow dealt in this report are in agreement with the books of account. Many times when we go for an MNC audit, they will have IFRS globally, which is adapted, or there are any other accounting which they follow, and the basis which they are unable to pass the audit entries which are suggested. The simple one, to give an example, depreciation. Depreciation here they may be following Companies Act, but globally the rates may be different. So they will not be passing depreciation entry. Forex entry will not get passed. In that cases, all these entries will be out of book entries. In that case, should we give a note here? Out of book entries means that will be captured in Excel or any other thing. So it will not form part of the books of accounts as such, or the accounting package. Any views on that? Maybe if anybody has gone through such circumstances as well. You're not auditing the Excel entries, you're auditing the SAP or Oracle or whatever they're doing. So opening balance, when we see, it will have the trial balance, which will come in SAP, which will not match to the audited trial balance. See, if the entries are not material and the company has a track, we can. Otherwise, Excel, mere Excel, we cannot tell that is the books of accounts as such. And if it becomes very material and critical, we may have to give a note saying that there have been differences due to the difference in the accounting package which is there. And many places it becomes very material in the case of cost plus entities only. Why? Because there will be depreciation entries, forex entries, and other entries which will come in, which will not flow into the main accounting books at all. And that is why many of the clients which are there, they maintain two parallel books of accounts. One for the parent entity which is there, and then from the Indian perspective, they keep it in the IGAP entries. And also here saying that the entity is complying with all the accounting standards. In case of Ind AS, we need to tweak in here saying that it is on the Ind AS. Then the written representations, which is very, very mandatory, has to be taken, which is the MVP1 and DIR rate. Here actually many times we falter out. The MVP1 and DIR rate is given. It is signed by the director and it is given. We will take on record and keep it. But what happens is, we are telling based on the written representation, none of the directors are disqualified. But if you go and search the DIN of the director, one of the company wouldn't have filed the annual return for 2 years or 3 years, and then he becomes disqualified. And hence that becomes very crucial that don't take mere the MVP1 DI rate, which is signed blindly by the director. Go one step behind and see whether all the companies in which he is director are still active. And because even if he signed and somebody is disqualified, it is again on auditor to tell that we have done additional whatever checks we need to do during the course of the audit. And on the IFC reporting, if there is a separate report, we need to tell there is an annexure. If there is no IFC is not applicable, then we can tell here not applicable. Apart from that, rule 11, there are 5 points which are coming in. One which says that there are no pending litigations in the company. Then if there are any long-term provisions which have been made for foreseeable losses for the company. The third one is the investor protection fund. Apart from that, there are another 3 clauses which are there. One, if there are any loans which have been given by the company to any outside and which are not been reported in the financial statements. The similar way where the loans have been received and this loan needs to be further for the purpose of further funding and the same is not disclosed in the financial statement, that needs to come in. Currently, I have not seen anywhere people where they have given some note on these two clauses. Apart from that, if there is any dividend declared, that will come. And now going further on the audit trail also, there is a one more clause G which will get added to this clause. So there are basically 7 clauses which will come in the rule 7. This is on the main audit report which is there, which I said this is the key paragraphs which will come in the main audit report. Here also we need to be very careful on the sequencing, which comes first and which comes other. Many places we see that, you know, the other matter comes before, the EOM comes later. Little bit very careful on the sequencing we need to see during the audit report preparation. And usually audit report gets prepared fag end of the audit, after all the discussions and other thing. That is also one more reason saying that by the time the audit closes, the team has moved to the other assignment. And this will be only a copy paste work which happens. So we have to give lot of emphasis on this because this is what will display the work what is done during the audit. As I was discussing during this one, I'll just open this one. Wherever we are giving the going concern note, this is how the audit report will look. There will be a paragraph which says that material uncertainty relating to the going concern. After this, when we move further, in the management responsibility, there is a paragraph here which says that the accounting principles are generally accepted in India relating to the liquidation basis of accounting. This needs to be added. Then also in the same paragraph, we have to also say that what is the modifications which have been there. This is in the auditor's responsibility paragraph, where we need to tweak in the last paragraph on the going concern and tell that there is a going concern issue. This report will be there along with the material which will be circulating. We can use it for reference as well. Apart from that, there are few more paragraphs where we need to add the going concern note. Many times during what we have seen is only this paragraph is added, saying that, you know, there's a going concern which is got affected. Subsequent paragraphs are not tweaked in or corrected. So still it will be copy paste from the previous report to the current report, but the tweakings wouldn't have happened. This needs to be done wherever we are giving the material uncertainty report. We key audit matters and EOM we just finished. Then this also I completed along with the main audit report. Yes. Yes, it is not applicable. That is why I said this G will come going further for 23-24 audit. No, it's not applicable that we don't have to give. Next year, once it is applicable, we have to give that.
Yeah, I seen some listed company, they mentioned the clause is not applicable for the current year.
Both the places it is there. There are a lot of companies who have not given that paragraph itself, saying that the audit trail is applicable. And for the safer side, we can tell. It's like in the schedule 3 changes, there are a lot of clauses which are not applicable. Both the scenarios are there where people give a paragraph big saying that all these clauses are not applicable. And many places they are silent and not quoting those clauses itself. Yeah.
The accounting rules, accounting rules are amended first April 20. We are mentioning that since it's applicable for the company only from next year, I don't have to report.
Yeah.
Because one is from 22, one is from 23. That's why everybody has taken that stand.
Apart from that, these are the few tweakings in the audit report wherever it is Ind AS is applicable. On the basis where we give the opinion, we need to tell the accounting principles followed are accounting standard followed are Ind AS standards, and then SOCI will form part of the financial statement. Then in the financial, apart from that, the last para where the reporting of legal and other regulatory requirement, we need to specify on the Ind AS. Moving further on the consolidated financial statement reporting. Wherever consolidated financial statement is reported, few things to be very much taken care. One, the title has to have consolidated financial statements. Second, wherever the entity has both standalone, that is the ultimate holding company will be preparing the standalone audit report and a consolidated audit report. So in that case, this holding company balance sheet, the audit report will state both hold standalone financials, standalone audit report and also the standalone financial statement. Very important to mention the standalone word, because we will not know whether it is a consolidated one or a standalone financial statements. So whenever we are preparing the consolidated audit report, we have to tell if it is a standalone financial statement. If we are giving the opinion on the consolidated financial statement, it is very important to say consolidated financial statement. Other than that, in the consolidated financial statement, there are few more things which will be additional. Wherever the parent is not the auditor of the component entity, there the auditor has to state that these many components have not been audited by us, and we have relied on the statements by other auditors, and basis which we are giving. And in that case, we have to also standard further goes on to tell, we have to specify the total assets, total revenue, and the cash flows which have been included in the audited financials, which has not been audited by the auditor. Also here there is one thing, in case the applicable accounting frameworks itself is different, then what do we do? For example, a few of the entities may be in IGAP, few of the entities may be in Ind AS, few of the foreign subsidiaries follows their own standard. In that case, whether we can give an other matter paragraph and go away? No, in that case, what we have to do is we have to bring it to the parent entity accounting framework, then only get it consolidated. So this is one thing very important. If at all we are doing the subsidiaries cannot be in IGAP and the parent cannot be in Ind AS. All the subsidiaries have to convert it into Ind AS, then only consolidation can happen. And another one main thing is all the audit of the subsidiaries needs to be completed. Auditor needs to see the auditor report of all the subsidiaries. If there are any qualification notes which have come in into those companies, that needs to be added in the main report as well. That is where many times there are, even though the company is very, very small and we put a small note also, it becomes a matter of great difficulty with the group company, because this note will come into the main entity audit report as well. This is again on the limited review. As we said, we have completed the audit report, which is the main audit report. Then wherever Ind AS is applicable, we have completed the consolidated financial statement. And this is on the limited reviews. Limited reviews, we will feel that it is applicable only for the listed entity and because for the SEBI reporting, and hence we don't have too many things to look at. But again, what happens is limited review can be given for any other purpose by the statutory auditor. It can, but only thing is limited review, the period of audit will be little smaller, maybe a quarterly, half-yearly review report that needs to be given. So here we will, the thing which the essay which will be following SRE is 2410, which is review of interim financial statement performed by the independent auditor needs to be added to. And in case of Ind AS 34 on the interim financial statements needs to be reported. Here the procedures will be little liberal than the normal audit, because we will only be giving the reasonable assurance and not the full-fledged audit report. And that is why the scope of work will be restricted and not having the full-fledged scope of work, which we regularly do in the audit. But this does not mean that we take only the management financials and sign and say it as a review report. There has to be enough of analytical procedures which we should demonstrate, which the SRE clearly says that as like any other independent engagement, the auditor has to do all the engagement, other activities like having the acceptance, then having the engagement team, doing the review, following the ethical requirements which are there. All those things that needs to be adhered to has to be done. And only then there has to be an opinion. Because it is little less in scope, the audit may not be very elaborate as such. And he,
and earlier the company used to follow IGAP. Then, but the acquiring company that is following Ind AS.
So a special purpose accounting report has to be prepared and everything has to be reported. So that will follow exactly which report? The Ind AS one or the older version? The statements which are being audited as in the mid-year.
See, where you're, if at all you're giving it for a purpose of 6 months or this thing, then you will have to comply with the 2410 review of interim financial statements. And you should be the statutory auditor of the company. If you are not the auditor of the company, then it will go to special purpose report, where you will be giving a special purpose report and not covering under the limited review report.
Okay. And even if it is in Ind AS?
Even it is in India,
2410.
2410 only. And I'll just show the report here. So when we say the limited review report, it is less in scope, and that is why the report is also very smaller. It's only a page, 1-page report which we need to give, which will have a title, introduction, which is there, which states the company name, balance sheet, what we are going to audit. And here in the first introduction paragraph itself, management responsibility is coming in, where it says that management is responsible for preparation of the interim financial statement. And our responsibility is only to express an opinion or a conclusion on the interim financial statement. Then on the scope of review, there are two standards, 2400 and 2410. Many a times only 2410 is taken care of. That is on the review of interim financial statement. If you go through the SRE is very elaborate, which says that what are the checks as an auditor we need to do when we do the interim financial statement. Though it is limited in scope, we have to do the whatever required work which is there for the audit. We cannot blindly say that because it is an interim, I did only variance analysis. The variance analysis did not show any difference, so I went ahead. We have to do the analytical procedures and review the numbers and the correctness. Only this can be done. And the third one is the conclusion, wherein we say that the financial statement for which we are giving the conclusion is in accordance with the applicable framework, accounting framework, which is there and has been followed. The difference between the main report and this one is, there we are telling we have followed all the standards of auditing. Here we are restricting it, and we are not going and telling that we have followed all the standards of auditing. But here we are telling we have been judicial and we have applied all the analytical procedures basis which this report has been given. And many a times we will be getting confused whether the limited review report or a special report or any other thing, because each of the reports are little different in nature. Only if you are the statutory auditor of the company where you are giving an interim, you can give the limited review report. Otherwise, it is the special purpose report. So going on the special purpose report, see, this is very critical actually. The other reports are the one where we have day in and day out dealt with, because all of us have been handling the statutory audit, and then we have been giving the audit report. Either it may be an IGAP, Ind AS, consolidated, or the limited review we've been giving. But this is something which is very to be taken care of, because client pushes very hard in these kind of certificates and report. For example, when we are giving the net worth certificate, client will come with one format telling that this is the format I have. Please sign this and give. Numbers are tallying. The reports, the net worth certificate will be to whomsoever it may concern. Okay, then it will be a paragraph. Net worth of the company for the financial year is X. Okay, and this is matching to the books of accounts. They insist that this is the format bank requires, please sign and give. Okay, so that is where the standard has come in. As an auditor, we cannot be giving any report which says that to whomsoever it may concern, or we cannot give in without specifying the paragraphs what is required by the report. There is a guidance note which says that guidance note on reports and certificates for special purpose. This needs to be given. And hence in this report, the auditor either has to give a reasonable assurance or a limited assurance. Reasonable assurance is given where we are opining on the thing. That is where we can do a limited review, interim financial statements or any other thing. That is where the reasonable assurance comes in. Limited assurance is on the conclusion, where it is a statement of fact. Net worth of the company where we are going to certify. It is a conclusion based on the audited financials. So we are only telling based on the audited financials, this is the net worth of the company. So that is where we are giving, and that is a limited assurance. So both the things get covered here. And then we have to refer the guidance note, which is there, where it specifies whenever we do the special assignment, we have to follow all the ethical requirements and then the other requirements which are specified as a normal audit to do this one. So I'll just go further. On the format of the report, when it comes to the special purpose audit report, just open this, I'm not sure. Not able to open this. Sorry. I'm not able to open that attachment, but however, I'll tell what it is. So whenever the special purpose audit report is given, it has to have a title. Special purpose audit report and certificates we have been giving in case you are auditing any company, which is, sorry, we are giving certificates for any listed entities where they are going for an IPO or other things. There are a lot of certificates which come in as a bundle. So many, and many other certificates. Now Make in India certificate is there, fund utilization certificate is there. Many things which we will be certifying. We have to follow the format which is specified in the special purpose audit report. It has to have a title wherein we tell that this is the practitioner certificate or what is the certificate and to whom it is addressed to. In the case of other audit report, it is addressed to the members or to the board of directors. Here it can be addressed to anybody. In case you are giving the certificates to the IPO for the purpose of listing, it can be to the lead managers or to the debenture trustees or to anyone who is there. So we need to address it very properly here, and also the subject matter for which you are giving the certificate. This is one place where I feel the auditor, the practitioner gets pushed very badly, because to safeguard this, usually in case of a listing certificates, it is given to the lead bankers or to the trustees, where they will tell that, you give 100% assurance. Okay, so on the certificate, even a net worth certificate, I don't think we should be able to give 100% assurance. They also tell that, instead of true and fair, please put true and correct word. So these are the things which we need to push back to the client and tell, saying that we are not supposed to give that. And the standard does not permit us to give any of those things in the certificate. 15 CACB is income tax, where the format is specified and you do online. No. No, this one 15 CACB. Yeah, it is in the income tax, so it will be covered through the Income Tax Act. So in the special purpose audit report, whenever we are telling, we have to ensure that we have an engagement for the process. Even if it is a net worth certificate or a smallest of small thing, please ensure that there is an engagement letter. And when you start the certificate, we have to write saying that pursuant to our having our engagement letter dated such and such, we are certifying or we are confirming the net worth of the company. And many times it is better to take a management annexure which is there. We can tell saying that this has been certified by the management, and we based on whatever the certification received, we are fine with the same. And with that, what will happen is we are mitigating the risk. And here we can, in the management responsibility, we have to tell saying that the responsibility of preparing the certificate or the document is with the company, and we are here only to give the thing. And again, on the auditor's responsibility, please give reference to SQC1 and also to the audit report, the guidance note, which is on the special purpose. Only then we will be able to tell that what is the basis of giving, and then the limitations. Because when it is on the audit and other things, we are following the engagement letter, and there we will be giving the confidentiality and other clauses. But when we come to the special purpose, it is an independent assignment, which is on need basis from the client, and it can come on a random basis. So better to put all the limitations what have been there, which you have faced during the course of the handling the assignment in the report itself. For example, many times what happens is the client will not give you all the information. Client will give only the limited information and tell basis which you certify. So it is better to tell that we have seen XYZ, but we have not seen ABC in this, and that is the basis that we are reporting. Also, the restriction of the liability. many times we get a net worth certificate for tender and client will come on a generic basis. We want net worth certificate for 3 years. Why? Apply for tender. Which tender? I'm applying so many tenders in the full year. I'll use the certificate generic. No, it is not so. We have to specify the tender for which this certificate has to be issued. Every tender we have to issue a separate certificate. It cannot be for generic use. The certificate has to specify for which tender, for what purpose the certificate has to be used. And without the permission, it cannot be used as a general document. And also on the liability. Many times the certificate what we are certifying, the amount may be a bigger one. And hence the liability of the auditor, then the fees what we are charging is 4,000 rupees for the certificate. It cannot be that tomorrow somebody questions, the liability comes on that. So we have to be very clearly, explicitly stating in the certificate that our liability is limited. And many times we also quote that our liability is limited to the extent of the fees what we have quoted. So by that we are safeguarding ourselves. So in the audit report, because we follow essays and other things, we are quite safe. But when it comes to the independent, when we give the special purpose certificates or the audit report, we are actually exposing ourselves to a much bigger risk. So it is very, very important when we are giving the special purpose report to specify. Even on the fund utilization certificate, which the NGOs are given, we many times they only tell this is the fund received, this is what it is utilized. But literally you are telling that the funds have been utilized. That means 100% verification has to happen of that particular project. Only then a fund utilization certificate can be given. So wherever these things are there, we have to. And one more thing, nowadays we're getting a lot of Make in India certificates, many Make in India certificate, and it comes saying with a tender, which is there. In the tender, they will tell there is one annexure in the tender, which has to be certified by the statutory auditor. So the company tells that even if you write a comma in the certificate, our tender will get rejected. So we will not be taking any word in the certificate what you are going to issue. In that cases, what do we do? This is some common thing which has come up saying that, this is my tender document. This is the annexure which has to be certified. And that annexure is very clear. This is the amount what it is to be certified. That's all. There is nothing which is there. And even a small full stop and comma other than what has to be written, the company does not agree because the tender gets rejected. What do we do in that case? Where? Certificate, even a comma client will not allow to add, sir. Where? Certificate we can. So what we do in this scenario is we issue the certificate full-fledgedly. As an annexure, we give the Make in India whatever the annexure it is there. No. In the main report, we are referring to that annexure, sir. In the main report, we are giving it as an annexure, saying that because of the Make in India, we are going to issue, and this whatever the report is there is annexed along with. The client will annex only the annexure, but from an auditor perspective, I have given him the full-fledged thing. Even UDN, they don't agree to mention sometimes. No, we are not very scope limitation number wise. We are very particular on the numbers. That data is given. Everything stated in the certificate is true and fair only. There's nothing which will be in ambiguity. But the problem is government does not allow them to do any modifications on the annexure. And this is one of the common, any of the PSU which is going for a tender or any company, they will come up with the Make in India. We can explore, sir. That is what we have found as a remediation, that we will give a report. We'll give a certificate. Along with that, the annexure is the report. If there is some better remediation, yes, we can follow that as well. Or we have to give a recommendation to the government to let us give a certificate in our format. So now comes the this thing saying that what are the common mistakes during the audit report review, which is there. So many times when we see the audit report comes in the fag end of the audit. After all the audit is completed, the article executive or anybody audit executive prepares the audit report. So what do? They take the last year's format, paste it in the current year, and then start doing the changes. So if there are 5 places year has to be changed, they will change it only 4 places. So this is something very much common which we have seen. Then the statement of P&L has to be mentioned as statement of profit and loss. We will only say profit and loss account. So they'll not know the exact terminologies, what needs to be known. So it is better that when we are reviewing, we be this thing. And then in the main report, we also say that statement of profit and loss account and the loss for the year ended is such and such. Okay. So the company was lost in the last year. Current year it is profit. Because it is a copy paste, it is not at all changed. It still comes as loss. And this is one of the common mistakes which I find in many audit reports. Last year loss, current year also it will be showing loss. Maybe when we are reviewing audit report, this can be seen once properly. And in the first year of incorporation when the company is there, the audit report states everywhere for the period ended, period ended, period ended. Next year it is a full year. Copy paste again. The period itself is not changed. It is still showing as a period. We have to change for the year. And cash flow statement, many places balance sheet and P&L statement of P&L is there. Cash flow does not come into the audit report only. So when we have to be careful as what all things form part of the financial statement, everything has to be taken care. Then CARO reporting, which is to be done. Last year it was applicable. Now it becomes not applicable. When it is in the below the report of the legal and regulatory requirement, same thing gets copy pasted. There is no annexure of the CARO, but the main report shows that CARO is annexure is there. And if there are multiple qualifications, appropriate words will not be taken care properly. So few things, these are there in the main audit report, because other paragraphs are all copy paste. If you see basis of opinion or auditor's responsibility, management responsibility, unless specific tweakings have to be done, can be copy pasted. But other things where it has to be changed, those needs to be taken care of. And thank you for the patient hearing.
After getting to know the theory part of recent updates, the practical aspects of recent amendments with regards to audit report formats was very well handled by CA Heena Kauser AP. A round of applause for the time and efforts. We thank all 200 plus members who have supported for today's and tomorrow's conference. Requesting all of you to support Bangalore branch in future programs also. As a token of gratitude and respect, we would like to hand over a memento to CA Heena Kauser on behalf of members present here and then on behalf of Bangalore branch of SFICI. I request CP Jain, our MC member, to come out to dais and then hand over memento to speak. Thank you. Thank you, one and all, once again. Let us meet sharply at 9:50 a.m. to attend a session by CA MP Vijay Kumar sir at 10 a.m. Thank you.